Hello everyone, welcome to the Edgemoor Investment Advisors first quarter 2020 market recap and outlook. I'm Jordan Smythe, and I'm here again today with my colleague Gay Truscott. And by here, I mean that we are each at home and splicing together this presentation while working remotely, something we've been doing for 5 weeks now, as I'm sure many of you have as well. The transition has been remarkably smooth so far. As you can see from a few pictures of some of our home office setups, we either have our work phones on our desk or have forwarded our work numbers to our cell phones. We've also been using Zoom for our regular investment committee and staff meetings. And we look forward to being able to safely return to working together in our offices, of course, but we're pleased to report that we've been able to continue our work on our clients' behalf. We hope you are safe and healthy in these strange and challenging times, and we appreciate your joining us for this presentation. We're going to share some observations in our outlook with you, but we want to acknowledge up front that things are changing rapidly with the COVID-19 pandemic and the resulting impact on the global economy, and there's just much that we don't know right now. I'm going to start us off by providing an overview of the reasons for the stock market volatility and offer some historical perspective. Gay will then discuss the government's monetary and fiscal response, our outlook, and our thoughts on our portfolios. I'll wrap things up by sharing some likely implications of the pandemic on our lives and on the global economy. The stock market followed its very strong 2019 by continuing to rise this year into mid-February, with the S&P 500 index hitting its all-time high on February 19th. Then things started to change very rapidly in our world and the markets. The primary issue was and remains the worldwide spread of the novel coronavirus and the disease it causes, COVID-19. As the virus spread and became a pandemic, it became increasingly clear that countries across the globe would need to take drastic actions to try to control the spread in order to limit the number of people affected and also to prevent hospitals from becoming overwhelmed with patients. Social distancing and the shutdowns of portions of the economy seem to be having a positive effect, as you can see in this chart of new cases of COVID-19 in various countries. The first wave shows the disease peaking in China in mid-February before the number of new cases dramatically declined. Later, you can see that U.S. cases peaked a week or so ago and are now also on the decline. Now, testing is not perfect, and the number of cases is likely much higher than the reported data, but the trend is important and reflects the efforts to contain the spread, which do seem to be working. The other primary issue affecting the global economy is the ill-timed dispute between Saudi Arabia and Russia over oil production. Shown here is the U.S. benchmark, West Texas Intermediate. Oil prices, as you can see, had already dropped for the first couple months of the year due to slowing demand caused by the coronavirus's impact on economic activity around the world. And then a price war between Saudi Arabia and Russia in early March caused prices to plummet. Oil has fallen now over 65% this year, crushing oil producers and other energy-related businesses. Now, normally, consumers would at least benefit from the resulting drop in gas prices, partially offsetting the negative economic impact elsewhere. But now we're not even driving our cars enough to realize this benefit. Government-mandated shutdowns of schools and businesses in response to the pandemic have sharply reduced economic activity, leading to mass furloughs and layoffs of employees and dramatic changes to our daily lives. The stock market reacted to the combination of these events by dropping 35%, one of the fastest and largest drawdowns ever, as you can see in this chart showing historical drawdowns. Fortunately, stocks have rebounded strongly over the past several weeks. The S&P 500 index, in fact, has technically entered a new bull market since it's now up more than 25% from its low point. Of course, we're glad to see this rebound, but we think stocks are likely to remain volatile as the pandemic continues and forecasts of economic growth and corporate earnings remain uncertain. Whether or not the market has bottomed remains to be seen, but it's important to put current levels in perspective. As you can see from this next chart of the S&P 500 index over a longer time period since the end of 2008, Even after the recent pullback, the stock market has gained about 290%, including dividends, since the financial crisis. Now, this data doesn't mean that it's not unnerving to see prices decline as much as they have recently. We invest our own money the same way we manage portfolios for our clients, and we know how stressful times like these are. But we invest knowing that there will be occasional and sometimes large downturns in the market, and we remain confident that stocks will continue to provide solid long-term returns for disciplined investors. I'll now turn the presentation over to Gay for a discussion of the government's actions to shore up the economy and our outlook.
Thank you, Jordan. In response to the outbreak, central banks and governments around the world have announced aggressive initiatives to mitigate the economic impact of the pandemic. In the U.S., the federal government response has been massive and has included both monetary and fiscal measures. On the monetary side, the Federal Reserve moved quickly and decisively in March, enacting in just a few weeks measures that took months to put in place during the 2009 financial crisis. They include cutting interest rates to near zero, launching a massive bond buying program, and just last week, committing to invest up to $2.3 trillion in loans to small and mid-sized businesses, as well as to state and local governments who have seen their budgets decimated by the crisis. On the fiscal side, Congress has also acted decisively, enacting 3 progressively larger relief packages so far, culminating in the $2.2 trillion CARES Act, which I'm sure many of you are familiar with. The CARES Act includes direct payments of up to $1,200 to individuals or $2,400 to couples, subject, of course, to income limitations. It includes a paycheck protection program for small businesses who retain their employees. It expands unemployment benefits, provides temporary relief for homeowners and renters, and includes corporate loans and assistance for some of the hardest hit industries like passenger airlines. We expect a 4th relief package may soon be announced, with more aid going to individuals, small businesses, state and local governments, and the overburdened healthcare system. Action on broad-based infrastructure spending may be delayed. As Jordan pointed out, these actions have been applauded by the stock market, with the S&P, for instance, soaring over 17% in the 3 days after the passage of the CARES Act, its highest 3-day gain in 87 years. What does this mean in terms of the long-term recovery of the economy and markets? Well, it's probably too early to tell, as we do expect markets to remain volatile as investors assess and absorb upcoming data on corporate earnings, unemployment, and possible negative GDP growth for 2020. But this next slide shows the S&P 500 return gains after major recessions like 9/11, including the dot-com crash and the Great Recession. You can see the recoveries are pretty dramatic, averaging 42%, which is that thick blue line in the middle, and led by the 84% gain 2 years after the Great Recession. So this gives us encouragement about the recovery to come once our economy is reopened. Let me now summarize some important observations about this crisis and provide our outlook as best we can, given the very real uncertainties that still lie ahead. The COVID-19 pandemic is an exogenous economic shock, not a structural one. By this, we mean that the U.S. economy and financial system were quite healthy before the shock, and therefore should rebound quickly. We are effectively in the midst of an engineered recession caused by the lockdown of most parts of our economy, schools, businesses, transportation, etc., which is highly disruptive and could last for a while, but is likely to reverse decisively once the pandemic is contained and businesses can reopen. We obviously applaud the massive monetary and fiscal stimulus packages enacted so far, and expect them to be effective in softening the economic impact of the virus. But we do expect stocks will remain volatile while the pandemic continues. Finally, we know that stock markets react quickly to both good and bad news, so we believe stocks might actually bottom, and may have already bottomed, we just don't know. But the point being that the markets can start to recover before the economy does. We at Edgemoor are monitoring market conditions and our clients' portfolios very closely, and we appreciate your ongoing confidence in our approach and in our stewardship of your assets. We thought we should review that approach and highlight a few portfolio actions we have taken. We believe, as always, that high-quality companies with durable business models and competitive advantages like the ones we own will rebound from this temporary threat and once again grow revenues and earnings well into the future. Having said that, we have sold a few holdings that we believed were particularly exposed in this downturn, a move that reduced portfolio risk and raised cash for future reinvestment. We are identifying several new investment opportunities and recently added Amazon to our equity buy list. Amazon shares pulled back slightly in the initial downturn, and we were able to buy on this dip. Overall, though, they've held up quite well, in large part due to the dramatic acceleration of its expected earnings, tied to increases in demand for its e-commerce and cloud computing services, both through this pandemic and beyond. We expect to find more new opportunities and will continue to invest available cash over the coming weeks and months. But overall, we are maintaining our long-term investment strategy of buying and holding high-quality companies that offer attractive returns to investors over a full market cycle. And with that, I will turn it back over to Jordan for final remarks.
Thanks, Gay. I'm going to wrap things up by sharing some thoughts on how the pandemic is likely to affect our lives over the coming years. As I said in the beginning, much remains unknown, but we think these are among the possible changes coming. There was already a backlash against globalization, most notably expressed through the trade wars that have now faded from the headlines in recent months. But now there's an even greater awareness of supply chain vulnerabilities and the potential for widespread travel to transmit diseases. So we expect the trend away from globalization to continue. Concern about government deficits and debt was already waning, and we will likely be living with the recent and coming increases for many years. As we've seen after similar downturns, we expect households and businesses to focus more on savings and ready availability of capital, at least in the near term, in order to protect against a future shock. Similar to the security screenings put in place after the 9/11 attacks, we expect to see more health screenings, perhaps as simple as routine temperature checks as we enter crowded situations like factories or stadiums or airports. We expect people to realize that some business and leisure travel is not necessary and in certain cases can be replaced with a video conference. And just as we at Edgemoor have learned how to work remotely, so have many other businesses, and we think some practices will continue and there will be implications for commercial real estate. Finally, restaurants will probably look different and have more space between customers, and we'll see similar changes in other places where people gather. These are very uncertain times, and we understand the anxiety caused by the pandemic, its disruption on our daily lives, and the resulting economic and market downturn. We remain confident in our investment strategy and long-term focus, are monitoring the situation closely, and will continue to adjust our portfolios as we see the need and the opportunity to do so. We hope you are staying safe and healthy, which is the most important thing for us to do to help get things back to normal, hopefully soon. Thank you for taking the time to join us. We hope you enjoyed this presentation, and we welcome your questions, comments, and suggestions. Take care.